The trustee is able to do a report to the Capital Market Authority, and us as a fund manager, we do a report every month to the Capital Market Authority on our what we call net assets value and the allocation we have done. So if there is any violation of the guidelines, the CMA takes action. So that is now what is supposed to happen to all the fund managers under the regulation. So that is it. Where you invest, if you start with a money market fund, it has the lowest risk. It doesn't invest in stocks. I don't want to say stocks are bad, only what I'm saying is the level of risk. Your capital is not preserved. In case the market sink, you drop with that. But you're also able to make more returns when the market is doing well. So as an investor, where do you start? You start where you are preserving your capital. As you grow, now you continue diversifying. Because you lose your capital today and you say, mimi na mambo na investment, I don't want to hear. So start somewhere for it, invest in the T-bills, the fixed deposit, no initial fee, no redemption fee, you can withdraw. Money market is what I would recommend, even for the sinking fund, where you know, I want to withdraw an emergency fund, I'll keep it in a money market fund. I want it in 2 days' time, I can access. That money that I have seated idle in my bank, put it in a money market fund. Let it earn interest there. Okay? Then you have no management fee. There's a management fee. How do we earn as a fund manager? We earn through a management fee. When we make a return, we are entitled to a management fee of up to 2.5% on the yield, but we make a 2%, which is we prorate for a year. So the client, like right now, the money market fund is at 10.7%, compounding monthly. The other aspect is when you are investing, look for compounding factors, whereby your investment is added back to the principal. And this is the compounding. If let's say I've invested 1,000 and I've earned 5 shillings. 5 shillings for the first month. The second month, the interest is added to the principal, and my whatever will be now 1,005. And the next day, because of this interest, you'll see you earn something like 6 shillings. Interest earning on the interest. So compounding is one of the wonders of the world. It does miracles. Yes, you add it there, it earns. So invest your money where there's a compounding aspect. But there are those, we call them, sometimes we call wealth fund or wealth management fund. Sometimes they have a fixed return, but it doesn't compound. Yeah, but most here they compound. The interest is earned daily, accumulated in like a month, and compounded monthly. And also, this money market fund can pay you interest monthly. You can say, I have $1 million or whatever. In the meantime, maybe I'm looking to do something and all that in my business, to import things and all that. I can have this seated in an investment vehicle like a money market. The interest earned there, it can be sent to you on a monthly basis, all reinvested back every month. Then you come to fixed income. Fixed income fund now invest in bonds. Money market is a short term for 1 year. That money for 3 months, for 6 months, I recommend for a money market. If you're looking for investment for 6 months and above, you can do something we call fixed income fund. Fixed income fund now invest in bonds, both corporate bonds that are issued by the institutions and what we call government bonds. So this is where it is. Then on the other side, we have equity fund. Equity fund now, instead of you buying the stocks, instead of you, this is a recommendation for 1 year. For stocks, if you're buying stocks as an individual, unless where you're active trader, you are getting in, selling, buying and all that, mostly we recommend a period of 5 years. You may buy a stock the following day, it dips, where we are with Safaricom. From the highs of 40 something to where we are right now, but with the value proposition of the business should grow. So you can buy for long-term hold and all that. So it's not a recommendation. I'm not making a market recommendation, that part of it. So but what I'm just saying, so equity funds, in terms of it's either you can buy the stocks, hold it for long term, or you invest in a fund that you're able to managed by investment professional like us, our equity fund, investing across Africa. But the thing is, with the equity fund, your principal is not preserved. Yeah, you can triple your money, but also you can lose part of your capital because it's the valuation of the stocks. Then we have a balanced fund, which is a mix of 50% fixed income and 50% of the equities. So, and also we have a fund called Nabo Income Fund, which we also invest in corporate commercial papers and all that. So, such funds, I cannot just tell you go for a fund. If you walk to any fund manager, you'll be given a product. But does it address the need you have? So what we do as NABO, and what I would say is different from the rest, is we sit down with you, understand your need first. Maybe what you need first is financial restructuring before we get to the investment. Or what you need is a money market fund or a fixed income or that. But the most important thing is sitting down with you, understand your needs, and give you an investment strategy and build different portfolios for you. So there, now you can talk to us, and that is what we do. And yeah, let's go to the Q&A.
I'm not sure if you finished the thought.
Yeah.
You said if someone gives you the rate,
Yeah.
you look at the government, security.
Oh, yeah.
Yes, you didn't finish.
Oh, I was saying when you're investing, what you need to check is where are the yield on the government securities, like the TBs. Where are they right now? Currently doing almost 12%, at 12 point something percent. Then investment that you are taking should be able to be within the government. After they take their margin of the management fee and all that, should be within that range. But also understand what are the underlying, any investment you make, understand what are the underlying assets. If I tell you I am making for you 20%, what is this that I'm investing in? Always go beyond to understand. Go beyond to research to understand what is the exposure and how am I covered. What is the point of your exit? Because sometimes you get into an investment vehicle and exit position are not defined. So when it comes to you to exit, you are not able to exit. Yes, please, there's a question. Yeah. Yeah, I'm done. Yeah. Yeah. So I think it's clear, eh? Oh, it's not. Yes, sorry. Money market. That 10.7. And inflation is 8.2 there. They are trading 364-day paper. We trade with we compare with 91-day. Money market compared to a 91-day is at around 11.9 to 12%. It's a good rate. It's within the margin. After you've taken the margin, of course, the fund is making a margin of, there's a management fee. After you take the management fee, now you have the yield. It is within the management. Let's get to her. Yeah.
I think it's an experience, and maybe to echo what you are saying, that sometimes you need to understand and diversify your investment.
Yeah.
Sometimes back I invested in, I think it was a money market. You know this jargon, sometimes they talk to you and they convince you, you don't know, you go into it.
Yeah.
And actually invested for 3 years, continuous 3 years.
Yeah.
And my money sank. I'm sure you all know about the Chase Bank. They didn't give us all the, I mean, I don't think in the bank, when you're going for the you're calling the money market.
Yeah.
The bank does not give you all the detail of exit. So that clause was not clear. We actually got to learn much later that in addition to getting our money in a span of 3 years, we were to lose 25%. That was such a big chunk of my investment that even today, I actually did what we were just explaining, investing from my earnings to get a passive income for 3 good years. Even today, I've never recovered because we lost 25% and there was not little money.
Yeah.
So I don't know whether we need to you people need to use easier language for us? Or
No, I agree.
Yeah.
One, and this is when you go to a bank, let's take a case of a bank. When it's the case of a bank in terms of the assets, the client deposit and everything, deposit and all that forms the assets that the bank is reporting. When it's going down in such a scenario, where is your deposits? When you go to the, and most of the banks, what they have done, they have the assets, asset management separate from the main bank, such that whatever is under the asset management, it is managed in a separate, like one of the rules given by the CMA, it is called segregation of funds. Segregation of funds is where NABO Capital bank account are should not be the same account where the client money are. Such that NABO can't use the client money to pay the salary or operations. Should be, account is in the Stanbic, our custodian, all our accounts are in different banks, the rest, such that they are not mixed. So what the banks are doing, they have this separately. You have a trustee who is not you, who is supposed to be an external to be able to give an independent view of the fund. So when you are interacting with them, with us as a fund manager, those are the questions you need to ask. Understand who is the trustee and who is the custodian at the same time. And where is this money invested in? And sometimes check with the regulator and see, because banks will always come with investment solutions. As long as you have client here, the next thing is give them the solutions. There is this, there is this, there is this you can take. So as a client of the bank, you trust the bank so much because maybe you've taken the loans and all that, and then you end up getting to their side. But here, it is there the catch is, where are the bank money and client's money separated? So that area. Later, yes, 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 the new development. So take your time and understand. As I said when I was starting this training, is that people have burnt fingers, and he has told you what has happened to that. And at least with the fund managers, we have not seen. We had a case of one which happened. They had an exposure in the Nakumat commercial paper, and they lost around 300-something million, and the CMA came into place and locked the fund for some time, because when there is a run, you can't sustain a fund, even if which strongest bank you have. When you have a run, you can't sustain that. So it locked. It was a fund. So the CMA locked the fund and said, give the fund for some time for the fund manager with the assistance and management of supervision of the Capital Market Authority to regain the liquidity. So with the time, after I think 2 years, they started repaying people's deposit, and no one lost their coin. That's the beauty thing when you come to the fund manager. So go areas where it's already regulated. Our sister had a question there. You can give her the mic.
Let's say I come to you and I invest for 2 years, and then after 2 years, for some reason, NABO Capital decides to close. Then?
Okay, now, this is a, let me take you back to this slide. Trustee and the custodian and the fund manager. The fund manager, we said, it is like a bridge between investor and investment opportunities. The money that is coming to you is not coming to the NABO Capital account. It is going through the custodian here and buying securities. When you buy the security, the custodian has a record of that, and the fund manager. The trustee is also aware of this. In case even client feel like NABO Capital is not representing us well, and they complain to the Capital Market Authority and the trustee, and they found that you breached the regulations, the client can fire the fund manager. You can have another fund manager coming into place to manage the assets which were under the custodian and the trustee. That's the beauty thing about this framework, whereby you can remove NABO Capital and have another fund manager manage. So in case NABO Capital is not there, there's nowhere it will sync with the client money. The money is already in investment, so another fund manager will be appointed to come run the fund under with the supervision of the CMA and these two categories. So that's the beauty thing about fund managers. Yeah. Our fee, I mentioned, is a 2% management fee. Yes, management fee, it is for money market. Like when we say 10.7, we've already deducted our management fee. So the fee is not charged on you alone, it is the fund size. So when you make the return, you have this 2%, spread that for a year, so you get bit of bit in every month. So when you come in, the return you are making, whatever we spread to you, it is what is earned by everybody in that fund, not you as just an individual. What you will earn is depending on the units you have. That's why it's called unit trust. When you come with 100,000, with the pricing of the units on that day, your money comes in as units. So the returns you're making is spread to your number of units you have in that fund. So you get a gross return less the withholding tax. The next thing is when you are getting to you as a 10.7 is gross of the withholding. So we get our management fee there. Then the rest we give it to you. On a monthly basis, we report net of withholding tax. And you can build different portfolios. You can come in as just a fund, or you can come to something we call managed account. Managed account, this is one of the platform we offer to help you manage more of your investment. Maybe you have shares you bought somewhere, you have bonds you bought somewhere, or here you're looking for to buy a bond, but it's not just a fund. We can come up with a custodian. We open for you a custodian account with your bank, separate from the current account you have or the bank account. We open a custodian account and buy specific securities for you and manage that portfolio for you. And there we can negotiate the returns even to a lower than 2% depending on what size. But a minimum of at least 10 million. If you are 10 million and above, we're able to manage such a portfolio for you. And that one will be able to even to reporting directly. Like, this is the security we bought. This is where maybe you can even come and say, I want to buy this security, not just even in Kenya. We do the analysis and all that, and we place the money for you and monitor for you and be reporting from that managed account. Yeah. Yes, please. Is that a question?
I would want you to do a practical, kindly, on the money market.
Okay.
If I was to invest 200,000, what would be my return?
Okay.
Yeah, with an able investment portfolio.
Yeah.
You start with 1 million kwenda juu. Is that true?
We used to.
Okay.
It used to be 1 million, but right now you can build from 10,000 and building it up.
Okay.
Yeah, but used to be 1 million most asset classes. Yeah.
That's all I wanted to know.
So from 10,000 you can build the portfolio. And mostly this session was not more on the selling the product and all that, but the journey we've talked where we were, I think it is what has brought us here in terms of paying yourself. When you pay yourself, where to take the money? I would advise, invest this money. Maybe you are somewhere already you're investing, you can continue building that, and also you can also consider NABO in your portfolio. Yeah. Investment advisors or fund manager, like where you're investing the money. Yes, no problem. You can have more than one. Diversification is good. Yeah. Yes, please.
Because investing in T-bills, T-bonds, all those, does the risk factor go up depending on the people that are in the power?
In the government, that one we call it sovereign risk. And when we say it is risk, from the top, mostly we check what are the risks in the government, what is the debts the country is currently holding, sovereign debts. We check what are the sovereign debts we have, what is the capability of the government to honor those obligations, what are the ratings that we have, and with the support of like what we're seeing the IMF doing and all that, how is it working? We've seen countries like Sri Lanka giving clients what we call a haircut on their investment, including the international investors, where you're told whatever you've invested in the country or in the government, you are losing 30%. And the other thing would be restructuring the Ghana way, saying whatever was supposed to mature in the next 1 year or 2, you add like 5 years to give the government time to turn around the things. So I would say it's more of a sovereign thing. You need to analyze not just the person on the top, but also the country, the whole economic perspective in terms of what are the prevailing things, and also things like the kind of the inflation we're having in the country. You also check, is it alarming? The central bank rate is inflation rate target is between 2 to 7.5%. If it's going to double digit, that should worry you. Where you're getting to 10, 11, Ghana hitting 50% on the inflation, meaning your money is almost 50% less than in terms of the purchasing power. So those are the things that you do an economic. But as where we stand, we don't have an alarming situation. But of course, there are various ways and also accountabilities here and there that need to be done. Yeah, that's what I'll give it. Yeah, being neutral in the market. Yeah. Yes, please.
I'm very blessed by this meeting.
Thank you.
It's very encouraging. I wanted to ask 2 questions.
Yes.
One, for example, I was saying like holidays, for example. Would that come under paying yourself or paying others?
Paying yourself, and you put it under sinking fund. If you know your holiday is November, you can have a money market fund for that. I've seen most of my clients doing that, where you're depositing something small. If you know you need 100 or you need a 60 or 70, you can break that into amount where you'll be putting monthly. Then the time of holiday comes, you just notify the fund manager, withdraw, go for your holiday, then come back. Okay. Yeah. So that will go mostly to the sinking fund.
Sinking fund.
Yeah.
Okay. I also wanted to ask if you're planning to start something like a business.
Okay.
For example, like getting a loan. I've not worked for over 20 years, and my husband has just retired, but from United Nations. Can they consider that a loan, considering that, or, for example,
like for the bank?
Yes, bank, or even if you're to get money from your
for fund managers, our license does not allow us to lend. Okay. So mostly, if one is in a circle, the best. I see SACCO as a good way of accessing cheaper capital financing compared to the traditional banking, because you borrow against your savings and you're able to get even 3 to 4 times of your savings depending on how much you've done. So I would say a SACCO would be a good alternative borrowing to be able to expand the business.
Is there any particular one you could advise, or?
I think that one we can have one-on-one. Yes.
Okay. Yes. All right. Thank you so much.
Thank you. So we have let's say you have a money market fund earning at 10.5%. When you minus withholding tax, you get a net of 8.3%. This is the withholding tax is always the final. So whatever we hold here, you're not going to pay another one. It is final. And the point of exit, will file that to your PIN, to your tax, to your PIN. You'll always see there when you're doing your returns end of the year. So you do 200,000 with earning at this rate. This is what will happen. Your opening balance the month of August. You can go the other side there. Let's say the month of August, you'll have about 200,000. The net return for that first month will be around 1,430. Then this is what will be the closing balance, around 201,430. The second month of September, the closing balance becomes the opening balance, the compounding aspect, where the interest is added to the principal and it becomes the opening balance for the next month. Then the next month, the interest goes up to 1,440. In this case, you are not doing a top-up. You also have an option of doing a top-up. But if you're not doing a top-up, if you go this August to August 2023, your portfolio will be at around 219,408. So this 200,000, maybe you wanted to use it in 1 year's time. Actually, money market I would recommend for 6 months and below. But once it goes 1 year and above, I'll move you to this fund. We call it fixed income fund, earning currently at around 11.5. So you can put this for fixed income fund. If you put fixed income fund at 11.5, you'll have around 221 end of the year. So meaning you've earned around 21,000. If it was in the money market fund, it was giving us around 19,000. But now with the top-ups, the goal is not just keeping the money there. I advocate for top-ups. Let's say this investor does a top-up of 10,000 monthly and see what you're able to achieve. When we come and sit down, we say, you have a goal, maybe you want to, like for us, you want to do the company, how much is needed and in terms of that business. So we say, in 1 year's time, from your savings, how much can we build a fund to add that? So we say, invest that money in like a fixed income, earning this rate compounding, are we able to hit your goal? So let's say this investor does a top up of 10,000 and this is a column for top up. So you can see the first month the interest moved from 15,000 to 16, and as you move forward, by the time end of the 1 year, you'll have around the 2,690 average return on a month, and then you'll have do for me the total interest, this column for the interest, sum the interest for the month of from August 2024, yes. So in the month of, you're able to see you'll have around 27,500, almost 28,000 with the top-ups. Without top-ups, you have a difference of about, it was 21, around 21,000. So with the top-ups, you are able to generate an extra return coming from the top-ups and also coming from the reinvestment of your principal. So it works differently with different investment goals that you may have. If you have a lump sum amount, you can put maybe this month you put 100K there, you see more growth. If you put an example of like $1 million, if one started $1 million, yeah, if one puts let's say like $1 million, with $1 million, this is what is happening. The first month you're making around 7,000, and this is the interest. Keep growing. By the end of the 1 year, you know, on average I can get at 10,000 for my portfolio. And how much will be the total interest? Around 112. So the more the principal, the more you're growing the account, the more the yield you see. Yeah. So and you can work this even for when you're working a retirement portfolio. You say, I want to build this, then start paying me after 5 years. Like now, if you do 5 years, if you continue this plan in 5 years' time, this will be 2028. If you go 2028, 2028, if you started with 1 million, you've been doing a top-up of 10,000, you'll have around 2.4 or 2.5 million. 2.5 million, it is able to give you an interest of about 200,000 in a year. Meaning 200 divided by 12, you are making almost 20K average in a month. Yeah. So that's the decision that we make when you sit down with us. And that's what I do. That's my colleague, Anthony. So you can see us and we can walk the journey. But the most important thing what we are discussing is flourishing financially. How does that journey look? From the Bible perspective, you've seen it. You ought to pay yourself. You ought to be a good steward for everything that God has given you.